Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy, your morning brew of global financial update. Now, folks, post India's response to the terror attack, discussions around escalations have been doing the rounds, but by far there has been no major escalation by either of the nations, which is a good sign. On the global front, we also had the Fed FOMC meeting last night, and the updates are broadly as market expected. The Fed left the rates unchanged, but did mention the risks of higher unemployment and higher inflation has also increased. Even the trade deficit for the US has scaled new heights. Even US President Donald Trump is scheduled to speak at a conference today, at which the market participants anticipate an update on the trade deal with some nation can be announced. JK, should we expect the announcement on the trade deals to begin with? And should we also expect another round of inflation? What's your take?
Good morning, Shikhar. Yeah, I think the last 24 hours have seen a lot of news everywhere, including India. And of course, what I have seen is on the day when there is a lot of news, market moves are limited. And, markets move big sometimes when there is no big news also. Yeah, the news actually started with India yesterday when there was, the Indian military action was seen, destroying the terrorist infrastructure in Pakistan, and so that seemed to have been a successful operation. And then, although Pakistan also, stated a lot of strong words that they will retaliate. So far, as you said, no major action has been seen, and Indian authorities have also said that they are ready to respond to any undue escalation. Later, of course, the big event was the Fed meeting. Although the expectations from the meeting itself was quite subdued because no one expected a rate change, no one expected Fed to change their stance also in a big way. Although some of the statements from Powell and FOMC were significant, like risks of higher unemployment and higher inflation have risen, and the unemployment rate has stabilized, and labor market remains solid, quite contradicting there. And then committee judges the risk of higher unemployment as and higher inflation to rise in the coming days due to the expected policies on tariff. And they also stated about uncertainty about the impact of tariffs, and that is why there is justification for taking a wait and watch approach. In fact, Powell has attempted to, in fact, Powell refrained from answering questions that attempted to discern which of the Fed's two mandates would he care first, whether higher inflation or weak jobs growth, and he continued to point to statements summarizing that, Fed only acknowledged that uncertainty had increased, attentive to risk on both sides of the mandate, and also acknowledged that major noise in the data saying swings in the net exports have actually contributed to lower GDP, which you refer to. So I think Fed remains non-committal, and that was not a major surprise for the market. That's why the markets also did not move much after the Fed meeting. Then, of course, we have other news. Yes, as you said, the positive side is that Trump is expected to hold a news conference today announcing a trade deal with a major country. They have not mentioned which country it is. Recently, South Korea, India, and UK have been in the news, but some latest market speculation suggests that the deal could be with UK. Although some also mentioned about India, I think we'll have to wait and see for US morning to get the update on the same. At the same time, European Commission actually said they will announce on Thursday preparatory steps for the next countermeasures to US tariffs should their talks with the US authorities fail. And so they're also hinting at some restrictions on Boeing related imports. So that is not so encouraging. Another interesting development that we saw was Ukraine has started to consider a shift away from the US dollar, possibly linking the currency more closely to euro amid a splintering of global trade and its growing ties to the euro. So another hit to the US dollar dominance. which recently has lost its safe haven status and given a part of it to the single currency as well. Of course, markets have once again not reacted much, but it's a big news as a medium term is concerned. We have another important event of Bank of England policy meeting tonight, which is expected to cut rates by 0.25%. This is only the fourth time they are cutting, and of course, the Bank of England has been adopting a gradualist approach for changes in their monetary policy because too many uncertainties. Although UK economy has been somewhat robust in terms of growth, the inflation has been a major concern. And Bailey, BOE chief, has actually been stressing on the risks to the economy from the surge in global trade tensions. So I think, I think we'll once again have to watch what he says about the future course of the policy. And as we all know, Europe is also expected to cut rate again when they meet next month. And Bank of Japan, which was on the course to hike rate, has also held back, citing trade tensions. So overall, what you can see is that the trade tensions and the uncertainty surrounding it on and its impact on growth is keeping the policies of the other central banks on the dovish side somewhat, whereas on the other side, US is holding a very wait and watch approach. And one could say that actually the differential with the US is widening in recent times with these rate cuts. But that has not really helped the US dollar, which normally rises when there is a widening of the rate differential, and that speaks volume on the trend of the dollar, which is definitely on the lower side. Yes, once again, we have seen currencies holding very good support on setbacks, and dollar is continuing to be on the weaker side. Although Chinese yuan has weakened a bit after the rate cut by the Chinese central bank, and today their fixing was also much higher than compared to what it did yesterday. Chinese are not letting their currency weaken much until probably they see a good chances of a trade deal, from the US authorities. On the Indian side, markets are currently, in a unique situation where the global cues are less influential, and cues are taken from the uncertain situation surrounding the geopolitics involving India and Pakistan. Chances of prolonged conflicting is what the market will be assessing, which can happen if there is a retaliatory strikes by Pakistan and the situation is escalated. Though Indian forces are seen superior, and a prolonged conflict will mean, of course, that the government will be more focused on the same, and other key agenda may take a backseat for some time, and that could be some negative, development for the investors, because there is also a possibility of higher fiscal spending due to the war. So these things will keep the Indian markets subdued, although no major setback is seen. On the rupee yesterday, there was a good demand once again, and we saw USD hitting a 5-day high at 84.93. Indications are that this demand will continue as the conflict seems to be ongoing, and closely watched by the market players as to how things evolve in the coming days. So hopefully, it will end soon, and markets will revert to much more calmness. Thank you.
Okay, JK, that was really good. And yes, folks, although there has been no major escalation, but a prolonged conflict can turn out to be a negative update, as uh, also shown by the market participants. As of now, the markets are keen on watching what's going to happen with the BOE, although there is a good possibility of rates being cut. The governor has also mentioned or raised their concerns from the surge in global trade tensions, and so has been the stance by a lot many other central banks. BOJ held their uh, stance of rate hike for the time being, and pause their rate hikes for the time being, considering the same surge in global trade tensions. On the European front, European authorities have announced preparing for the uh, counter on the trade tariff front, while Ukraine has shown signs of moving away from its links to the US dollar and possibly building up links closer with euro. In the US front, as JK mentioned, the risks for higher inflation, higher unemployment have increased as understood by the commentary from the Fed, but the lower exports have contributed. It was the lower exports which has contributed highly to the GDP decline as well as a higher trade deficit. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for joining.